Hey guys, Doug the Retirement Guy here. We got requested from a couple of our Patreon supporters to help them with their portfolios. And we did something I think is going to be unique and I think everyone can benefit from. We put together 5 high yield REIT and ETFs, which are solid, great for retirement accounts. There's no real decay or NAV erosion in the funds. They're paying between that 12 to 26% total returns. And it just really fits well as a segment into a retirement fund, and we wanted to share it with everybody, and we're going to do that today. Notice to all viewers, past performance does not guarantee future results. This is for educational and informational purposes only. It is not considered financial investment or financial investment advice. These are just suggestions and examples. Always consult a licensed financial advisor or a professional before making any financial decisions. So we basically put together 5 great ETFs that are going to be great for your retirement accounts. As we said, they're paying 12 to 26% total returns. There's a lack of NAV decay. Really, we haven't found any yet. And it's kind of one of these that everyone always asks for is set it and forget it. And what this is doing is we're looking at every little angle of the REIT packages, which is into the mortgage. And if the interest rates drop as they're forecasting and talking about over the next 6 months, mortgage rates are going to skyrocket. We're going to be writing more mortgages, so we're going to make profit from that. The warehousing out there, office complexes, there's everything out there in the real estate business is going to take off over the next 6 months. So the first question is, what is a REIT? If you're not familiar with that, well, a REIT stands for a real estate investment trust. Think of it as a company that owns, operates, or finances real estate, like apartments, shopping centers, warehouses, office buildings, hotels, hospitals, and even cell towers. Instead of buying yourself, you can buy shares in a REIT, just like a stock, that gives you a slice of the income from the REIT's earnings of these properties. And here's the big things with REITs. The dividend income, by law, REITs must pay out at least 90% of their taxable income as dividends. So the more these things profit, 90% of it's coming back to the investors. And then the growth potential is property values increase, rents go up, so do the earnings, and so do the dividends. So these things are, I classify them, I like to call them cash cows. These are things that are kind of just going to continue to pay and continue to grow their dividends and continue doing it if they're doing things on the right basis. And that's why we do our research. Now, retirement portfolio slice. I look at this right off the bat, and we'll cover this a little bit later as well, but I look at this as only a slice of a retirement portfolio. The way I set my portfolios up is I don't put everything into one fund. I don't put anything into one category. I break it down to basically over 5 different categories. And the idea of that is not to have all my eggs in one basket. So this is why the REIT and the real estate side of it is only one little piece of my pie that I put into it. So I'm not looking for this to be huge growth or huge income, but I'm looking for a good, steady income. And if I can get some growth, even more power to it. I definitely do not want decay. So that's why I looked at these for lack of NAV decay. I don't want to see the price coming down. I don't want to see this thing being high and then all of a sudden hitting the rock bottom. I don't want to do it. And the main thing is with these funds, I want to set them and forget them. I want this process of my pie. I want this piece of the pie to just sit there, collect money, and I'm going to go over and play with the stuff that's the high risk stuff and keep an eye on that one. So this is why we built this accordingly, and where we put it into play is that think of this as just one piece of your retirement pie. So the first fund that we put into place, and that is going to be the Realtor Income Corporation, or these guys always like to say the monthly dividend fund. Their year-to-date return is 9.49. You can see that on the chart here. Even in the bad times that we had in the April drop-off and the August drop-off, these guys have recovered quickly. And I mean quickly, it's within 1 to 2 days. They're shooting right back to where it was because this fund is so well managed and the company does such a great business with this, that they're able to manage it properly in good times, bad times, and roll through it. Now, their dividend, 5.52%. Now, I know you're going to sit there, oh, that's so low. 5.52%, easily better than any deposit you can make on your money market account across the board. It pays a steady 26 cent per share per month. Look at the dividend chart that we have down below. This thing, we backed it up over 10 years. So already, you can look at this. Back in January of 2021, this thing has paid a steady dividend. And then at the beginning of January, it bumps up again. Pays a steady dividend all the way through. And 23 did the same thing. And this thing is set up to do this on a regular basis. That they pay out equally, and then they make an adjustment for the following year. It's just beautiful steps of going bigger, bigger, and bigger. So when you combine the two together, your 5.52% yield and your 9.4 NAV growth, you are looking at a 15.01 total return from this fund alone. So if you take this down the road and rebalance it at the end of every year, you can just keep adding more and more dividends to your portfolio. Now, how do they do this? Well, it's simple. They have in their top 10 industries, they are 10% in the grocery stores. They're 9.98% in convenience stores, home improvement, dollar stores, restaurants, drugstores, health and fitness. They are basically all the services that we need as humans that we need every day. And that's how they have the big client base. They work with the big ones, the 7-Elevens, the Home Depots, the BJ's wholesale clubs, Walgreens, Dollar General. And I'm not stopping there because they got CVS's and they got different casinos that they're into. There's a ton of things that O really works with, and very, very strong companies. Our second fund, and that is going to be EPR Properties. Now, here's the unique thing with these guys. Year to date, they're up 18.74%. Again, just like we just showed you, everything on this, when we have a downtrend, these guys recover quickly. They rebalance themselves and they get things organized. Now, the positive I see, even though this thing's an 18% growth, it's backing back up to the station saying, hey, we can get back on board at $52.58 right now. It has come down from its high point. Now, why is that? It is just partially they're preparing and investing more into properties. So they pay 6.73% dividend, and it pays 29.5 cents per share. And when we look at their dividend chart, look what it's doing. It's the same step we just showed you. Step up, nice steady path, step up, nice steady path, step up, nice steady path. So they're constantly growing their dividends. This is what we love about the REITs. They may not be the 10, 12, 20% numbers coming out of it, but they are a steady cash flow cows, just giving you the money in and out, in and out. So you take that 18% plus that 6.73 yield, together, you're cranking out a 25.47% total return. And again, this is a fund that I highly recommend. Every year, you rebalance your fund. Sell some of the funds off, rebalance it, and continue to put that money back into working for you. And how do they do it? Well, look what they're doing. 37% into theaters. They're 25% to eat and play. So now these guys are doing things that recreational that we all love to do. So it's not that they're into things that we need to live off of. It's things that we need to enjoy life with. You see how the number one fund and number two funds work so well together? Well, we're sitting here with fitness and wellness, skiing, gaming, lodging. So everything, they call it 94% of their package is experimental. Is all part of having fun. And then they get into education, private schools, childhood education. They're working on the educational side. Look at their fee-in program. 88% of their business comes from fee ownership. Okay, 11% comes from mortgages and notes, receivables. And then only 1%, less than 1% of their fund is actually that they have to manage. So it's almost like they have a machine just constantly creating funds coming in from what they're working with. They have $6.9 billion in investments. So this is a well-organized machine again. And they got 329 locations that they're doing this with. So this is not something that, here today, gone tomorrow. They are here for the long haul and been here for the long haul. Now let's take a look at our number 3 fund. That's SRET, which is the Global X SuperDividend REIT ETF. So this is actually one of our first ETFs that we're dealing with. Now, year to date, this thing is up 6.92%. Look at the numbers. Even in the April when it dropped off because of the tariffs, this thing recovered quickly and just continued to grow back to where it was originally, because this tells us that we do not have a problem, a physical problem with the fund. It's just bad news issues. So this one's right back to where it should be, and look at the dividend that it's paying, 8.38%. So we're right back up to where we have a little stronger return on our dollar. This thing pays 14.4 cents per share per month. And when we look at the dividend chart, this thing has been, back in 21, this thing was just steady for 2 full years, just steady paying out. Okay, then it made a few adjustments in areas that they understand they made a little mistake with, and all of a sudden they've come right back out of that hole, and they're back to a balanced approach. They are doing a solid return across the board. When you take a look at everything that we put together, an 8.38% dividend yield, a 6.92% NAV growth, we're a 15.3% total return. This is why I'm so excited about number 3 is in our portfolio. It gives us everything we want. A nice positive return, a very strong dividend payout, and just a steady flow on a regular basis. And how do they do this? Look what they're doing. This is the one that got me, is when I started looking at this. They start investing into, look at the bottom one, the Realty Income Corporation. They're buying into the fund that we put in our portfolio from the start. They've trusted, they invested into it. And they're able to pick up all the other ones, EPR, and then the Omega Health Group, Ellington Financial. They do a ton of business with mortgages. So these guys are able to bring a lot of different pieces of the puzzle together that we can't afford to buy, but gives us access and profitability from all of these different accounts. So then we took it, the 4th fund that we put into this is GNL, the Global Net Lease Incorporated. Now this one here gives us a year-to-date 2.47 return. They've done a fairly strong job staying positive all the way through. Their income comes in at 10.16 or 19 cents per share monthly. Very, very solid dividend again. We look at their chart. Prior, they were doing a solid 40 cents each and every month. Now, have they done something wrong? No, they're just rebalancing their portfolio. They've rebalanced things, getting it down. The price of the share has come down, giving us that 10% return, but we're back to a solid 19-cent dividend across the board. So this thing gives us a 10% yield, a 2.47 NAV growth for a 12.63% total return. Now, what are they into? What are we going to look into this? Well, they have 911 properties, over 44 million of square footage. They're 98% leased. Their average lease term is 6.2 years, and the percentage of the leases with increases, so the rent is going up, is 88% of their funds have regular increases into it. Now look what they've gotten into. This is what I, again, get excited about. They have a mixture of everything. Auto manufacturing. Who would ever think that we could get into being an auto manufacturing plant owner? McLaren, FCA. They get into financial services. And I'll tell you what, as soon as that financial service, 10% of their business, as soon as they get the financial services that starts kicking in, you'll see this thing start taking off as well. They're doing it with PNC Bank. The freight, they're in there with FedEx. Consumer goods, Whirlpool, everyone's needing washers, dryers, and so on. Dollar General, Aerosmith. They in every little market that we can talk about, they're across the board with. These guys are, like I said, global. They're doing things across the world. And then our number 5 is MORT. Now that's the VanEck Mortgage REIT Income ETF. Now this one has a year-to-date return of 0.66. Am I nervous about that? Not really, because look at what happened. The April tariff kick in, went down. They've recovered themselves, not back up to where they were, but they've recovered themselves back up, and they've had no help. They literally have had no help with interest rate changes or anything on that side of it. And what happens when the mortgage side of it has an interest rate drop? This one is going to take off as well. When we look at their dividend, 12.26. This is our big boy. This is our 12.26 that pays 26 cents a month. Now, because of this one, you're going to see some volatility in the dividend report as you see across the board. Now, why you're going to see this is because the more loans that they can write, the more loans that the ETF pack part of it can do, you're going to see big increases. You're going to see smaller pieces to it. The combo, 12.26 yield and a 0.66 NAV gives you a 12.92. This one's in here. Yes, I want the dividend income, but I'm also the guy who's saying this thing's going to take off. This whole REIT is going to take off. This ETF will take off as soon as the interest rates start to drop. And how are they doing it? Look what they got. The very first one, NLY. That is the Capital Management Group. They're the ones that are underwriting a lot of loans. The AGNC Investment Corp. Everything that they have, Starwood Property Trust, a lot of the stuff they have is all mortgage backed. They're all financials that are going to take off when interest rates drop. Because the forecasting that we continue to read is as soon as interest rates start to drop below that 6% rate, down to basically 5.5%, you're going to see a whole new home buyers coming in. If that thing gets below the 5%, you're going to see a massive home buyers coming in. People have pent up demands. And that's why we're preparing ourselves and our retirement funds for the long haul, the long term. So going back to a balanced fund, remember I talked to you that this would only be one slice of my pie? How do I break my thing down? Well, first one, we have a tech segment, and then we have tech segments of ETFs. And if you haven't seen it, we have a video on that. That was our 5 high-yield ETFs that are all basically built around the tech segments. This one here is our number 2 with the real estate ETFs and REITs. We also do one with banking. And then we do one with our high-yield income funds. These are the ones that we are not looking for growth. These are ones that we are looking for those 50, 60, 70% returns because we want that big, big income. But we don't want the piece of the pie. We got all the other pieces giving us growth, and that's our 5th one is growth funds, things that will just grow because we're dealing with number 4 for getting high yields. So this is why I tell you guys this is how you break things down into a piece of pie. I am not telling you that this 5 ETFs are going to set you up and retire on, but what I'm saying is this is a great support package to what you're working with. So we take a look at the projected results of this portfolio. If you invested $250,000 as part or as full retirement fund into this, you take a look at, we put this as the lowest dividend first to the highest dividend, the growth rates are put into there. And then we said, look at, if we take 15% as a base and then the 2 big dividend ones, 25 and 30%, and it's not just the dividend, it is that we expect both of those to just rocket. As soon as the interest rates drop, which is less than 30 days, I assume is going to be here, they will start to see this thing climb and they'll start to grow. So when we take a look at this whole fund, this is what gets amazing. A year-to-date return from $250,000 is going to give us $23,281 a year. Okay, that is $1,940 a month of income. Like I said, this is not something that's going to take and set you up for retirement, just these 5 funds, but you add that to a portfolio that's adding, I believe that other tech we use is like $52,000. All of a sudden, you're now at $75,000 off of a $500,000 report. Now, I don't want to get people confused combining 2 ETF funds together, but this is set up to be a great fund for you to just have a nice segment in the real estate market. The other big thing is look at the growth factor. Now, I love growth, but I always love income better. But even with this one, we're still gaining a $16,000 worth of growth. That's going to give us more income down the road. So it's a great package as a whole to put together. And in summary, you got a solid return about 9.2 average. Okay, you got a growth rate of 8.44%. You're wisely limiting your risk in retirement. And with no NAV erosion from these funds, boy, this is a win-win-win situation. You have a success where we dial you right into a particular fund and particular group that you can win across the board. So this is one of those set it, forget it type programs, and you're not going to have to worry about it. Guys, this is Doug the Retirement Guy. If you like what we're doing, give us that thumbs up. If you're not part of the community, hit that subscribe button. Get all of our videos on a regular basis. And best of all, if you have any comments, leave them down below. And guys, as we remember, past performance don't guarantee the future results. Always talk to your financial advisors.